Dear students, in today's class, you are going to learn the different methods of maintaining partners' capital accounts in a partnership form of business undertakings. You know that a partnership form comes into existence by an agreement. Therefore, once the business is commenced, they are required to maintain all the business records as per the Partnership Act of 1932. Therefore, here partners' capital accounts can be maintained by following two methods. One is the fixed capital method. Next one is fluctuating capital method of accounting. Methods of maintaining capital accounts. First one is fixed capital method. Second one is fluctuating capital method. Fluctuating capital method. Okay, let us study in brief both the methods. First one is fixed capital method. What is the meaning of a fixed capital method? As the name itself indicates, whenever a partnership business is commenced, a capital account in the name of each and every individual partner is opened. In that capital account, all the entries relating to that particular partner are recorded. For example, whatever amount of capital is invested by the partner is recorded in that capital account, and also other entries like salary, commission, interest on capital, interest on drawings. See, whatever the entries pertaining to that particular partners are there, such entries are made through that particular account. But here, in case of a fixed capital method of accounting, only the capital invested by the partner is recorded in that account, and other entries like salary, commission, interest on drawings, interest on capital, etc. are made through a separate account. That account is called as current account. It means under fixed capital method of accounting, in the name of each and every partner, two accounts are maintained. First one is called capital account. Next one is current account, that you have to remember. Then why this capital account is called as fixed capital method? Just you see, A and B are two partners. They agreed to invest rupees 1 lakh each. Here, A and B are called as partners, and the capital accounts are opened in the names of both the partners. You take A's capital account will be opened. A's capital account. This account is credited with the amount of capital invested by that particular partner. How much amount he has invested? Rupees 1 lakh. Okay. Assume he has brought that one in the form of cash. By cash account, rupees 1 lakh. This is the amount of capital invested by A. And in this capital account, other than this, no other entries are made, like interest on capital, interest on drawings. Next one is his share of profit or loss. No other adjustment, or no other entries are made through this account. Therefore, here at the end of the year, assume that the capital of the partner remains same. He has neither introduced fresh capital nor he has withdrawn his capital permanently. In that case, his capital balance remains same at the end of the year. That is why here, if we close this account, how do you close it? To balance carried on rupees 1 lakh. 1 lakh. Then in the next year, the same will become the opening balance. You see, by balance brought down. By balance brought down. Again, rupees 1 lakh is to be taken here. And again in the next year, if he introduces some capital, then that has to be entered here. Only entry pertaining to the capital is to be entered here. If he has withdrawn the capital permanently, some of the amount he has withdrawn permanently, that entry will also appear in the capital account. It means the entry which is affecting the capital balance of the partner is entered in the capital account. That is why here most of the times here capital remains same. In case if the introduction of the new capital is there, if the additional capital is introduced by the partner, in that case, what is to be done? That entry is required to be taken here. Assume he has introduced during the year some amount of cash. Assume rupees 5,000 he introduced as additional capital. Next year, the capital balance will be rupees how much? 1,05,000. To balance carried on rupees 1,05,000. Next year, again, the same balance will be there. To balance brought down rupees 1,05,000. In case if he doesn't introduce additional capital, his capital balance remains same for all the years. Therefore, this method is called as fixed capital method of accounting. Just you have to remember this, that in capital account, only the amount introduced by the partner towards his capital is recorded and no other entries are recorded in this account. Therefore, the balance in this account remains same for all the years. If there is any additional capital, that time the capital will change. Okay, next one is current account is opened in the name of each and every partner. Current account. What is this current account? In this current account, all the other entries are recorded. Assume this is A's current account. Just I will take here A's capital account. He introduced how much? By cash account. He has introduced rupees 1 lakh as his capital. Only this capital is recorded. Only the amount which is invested by him towards his capital is recorded in this account. No other entries are made. But other entries like salary, assume he is entitled to get salary from the partnership firm. Salary rupees 10,000. This is to be recorded in A's current account. Next one is he is entitled to get commission from the firm. Assume rupees 2,000. Now he is entitled to get his share of profit, that is profit and loss appropriation account. We have to take profit and loss appropriation account. His share of profit, assume rupees 5,000. Like this, we have to enter by interest on capital. By interest on capital, assume rupees 1,000. And he has made the drawings. He has withdrawn the amount for his personal use. Assume rupees 3,000 he has withdrawn. And interest on drawings has come to rupees 500. See, these are the entries which are generally made in the capital account, but under fixed capital method of accounting, only the capital invested by the partner is recorded in that account, and other entries like salary, commission, his share of profit or loss, even goodwill, and the interest on capital, interest on drawings, you see, all this type of entries are made through a separate account. That account is called as partner's current account. This method is called as fixed capital method of accounting. Next one is come to the fluctuating capital method of accounting. Okay, let us take one simple example so that you can better understand both the methods of maintaining capital accounts of partners. You take X and Y. X and Y are partners. X and Y are partners who introduced rupees 50,000 and rupees 80,000 introduced rupees 50,000 and rupees 80,000 respectively into the business on 1st January 2024. They also invested rupees 10,000 each as additional capital on 1st June 2024. Partners are entitled to get to get 5% interest on their investment, interest on their investment, during the year, both the partners withdrew rupees 2000 and rupees 3000 for their personal use, and interest on drawings, amounted to rupees 300 and rupees 400. X is entitled to get a salary of rupees 1000 and commission of rupees 500. Share of profits of both the partners amounted to rupees 4000 and rupees 5000. Prepare partners capital accounts. Under fixed capital and fluctuating capital method. See, I have taken a very simple example here so that you can understand it in a better way. Just you see what is given here. X and Y are partners who introduced rupees 50,000 and rupees 80,000 respectively into a business on 1st January 2024. They also invested rupees 10,000 each as additional capital on 1st June 2024. Partners are entitled to get, this one I will take as 1st July so that 6 months, this one interest can be calculated. Okay, partners are entitled to get 5% interest on their investment. During the year, both the partners withdrew rupees 2000 and 3000 for their personal use, and interest on drawings amounted to rupees 300 and rupees 400. X is entitled to get a salary of rupees 1000 and commission of rupees 500. Share of profits of both the partners amounted to rupees 4000 and rupees 5000 respectively. Prepare partners capital accounts. See, if this type of information is given, we need to prepare partners capital accounts under fluctuating capital method and under fixed capital method. First, prepare capital accounts of partners under fixed capital method. Capital accounts under fixed capital method. Fixed capital method of accounting. First, we will prepare excess capital account. Next one is Y's capital account. Next one is we prepare excess current account. And in the similar way, we also prepare Y's current account. Here important thing you remember, under fixed capital method, two accounts are maintained. One is the partners capital account, next one is partners current account. But in case of fluctuating capital method, only partners capital accounts are maintained but not current accounts.